Now, despite the volatility in 2011, the S&P 500 is ending the year at just about the same level it started it at. What were some of the money-making strategies in a year of wild ups and downs in which the S&P fell as much as 20% from its high, and very little net change at the end of the day? And can investors count on those strategies next year? Our guest says to hedge with an edge. Joining me now from Philadelphia this morning is Sean Heron of Glenmede Trust. Sean, good morning to you. 2011 was certainly all about managing your risk. So explain to us what hedge with an edge means.
Good morning, and thanks for having me. Hedge with an edge is basically hedging strategies that take advantage of advantageous pricing, meaning there's a positive expected risk-adjusted return for a strategy that has advantageous pricing at the beginning of the year, and therefore is a good time to enter into it.
A lot of people think being defensive is a good strategy right now. Hiding out in dividend-paying blue chips, for instance, like the pharmas, the utilities, the consumer staples. We know that these sectors have been a bit higher, and they're trading at the highest multiples since 2008. Is there a more creative way to gain the same kind of exposure through options?
So I think the short answer is yes. There's a number of ways you can be defensive, and defensive was a theme in 2011 and should continue to be a theme in 2012. The question just is, how do you get creative so that you're not just overpaying for overvalued assets, whether they're ones that have done well like the dividend yielding stocks you just mentioned, or alternative strategies like over-allocating the cash and treasuries where yields are basically next to nothing, but you would have to expect a negative real return and be willing to accept that to ride out volatility using treasuries. So what we would actually recommend is maybe consider option-based strategies instead.
Such as?
Such as strategies that can take advantage of volatility is high, so therefore the VIX index is high, which means options are expensive. And when options are expensive, it's probably better to sell options than it is to buy them. You also have a skewness happening between downside protection being much more expensive than upside participation. That also lends it to certain strategies. So we would recommend considering a covered call, a cash secured put, or a put spread collar, as opposed to strategies that buy options like a protective put or any of the long volatility strategies.
Gotcha. Now, speaking of volatility, volume is so low right now, and it could continue to be a factor heading into next year as long as overhangs like the European sovereign debt crisis remain. Could this low participation undermine certain hedging strategies?
Actually, it helps certain strategies. So if volatility is expected to remain for the foreseeable future into next year, those elevated levels of volatility will give you the opportunity to not only sell options this month, like in a covered call strategy to take advantage of rich option premiums, but sell them again a month from now and a month after that. It basically allows you to continue the strategy throughout the year and capture those rich option premiums until, of course, everybody says all clear and the market's expected to go higher without any volatility, but we don't foresee that anytime soon.
All right, everyone's trading in the same markets these days, and we've got to keep track of European politics and calendars of European debt auctions. How often do you put on and off a particular strategy, and has your time frame had to shrink because of the extraordinary amount of events that you need to keep track of?
Yeah. So if the event was considered to be a short-term event, meaning it's going to be over in a month, you tend to want to capture as much volatility in the sale of the option as you can by selling longer-term options, and then when the event passes, volatility collapses and you make the premium. It's kind of like longer duration for an option person. However, if you expect the volatility to remain high throughout the year, it's actually better to roll short-term options, meaning roll options on a monthly basis and capture the premiums in a faster way because they will expire worthless within the next 30 days. And you know the volatility remains high, so future option sales will also benefit from the strategy.
All right, thank you so much, Seth, Heron, Option Strategies Manager over at Glenmede Trust.